Welcome to the second debate on the global environment for central banking, economic spillovers, geopolitics, and diverging economic trends. When anticipating the session, I thought maybe, even with limited expectations, let me ask AI, what is this going to be about? Limited expectations because usually when I ask AI to solve even the exams for my undergraduates, it's still regularly in the failing area. But okay, so I tried nonetheless, and here's the answer that I got as to what to expect from this session. I quote, "Geopolitical tensions have replaced inflation as the primary concern of central banks." Okay, I stopped there, of course, and reverted back to my own thinking, and in terms of what I hope we may be able to hear from in this debate is on the spillover side, perhaps prominently financial markets, perhaps also including issues of potential overvaluation of assets and their spread across continents. On issues of geopolitics, it's very obvious what we all have on our mind, but maybe in this context and also given the decomposition of the panel, we'll also be able to think about a bit rising tensions between the world's two superpowers, China and the US, and where the euro area is in all of that, and on issues of diverging economic trends. That makes me think a lot about issues of rising debt levels, particularly in emerging market, developing economies, and the kind of spillovers that may introduce and what risks that will pose for central banks. Let me introduce our first speaker. I'll introduce the other speakers then just prior to their presentation. We are very honored to have as our first speaker Governor Rehn from the Central Bank of Finland. As you all know, he has served for more than 10 years prior to his appointment as governor, as European Commissioner, both for enlargement and monetary affairs, as well as the euro, and has another honor, namely that he's at some point gotten on the wrong side of Paul Krugman. Paul Krugman wrote during the time when Governor Rehn was serving as Commissioner for Monetary Affairs in the euro, that his policies are a predictable disaster, voting. Well, they didn't turn out to be a predictable disaster, and I think not that you needed the session this morning, but we also heard in the session this morning, right, what actually is the huge risk of loose fiscal policies for not just central banks, but for economic development at large. And so, without any further ado, it's our great honor to have you. Looking forward to your presentation.
Ladies and gentlemen, dear friends, and dear Michael, thanks very much for very kind words of introduction. I recall also that Paul used to call me the reign of terror. And it just proves that I think Paul is more of a macroeconomist than a political economist, which very much is about what the European Union is about. We were then 16 members of the euro area, and some people were predicting Grexit or Fixit or whatever. Well, today we've seen that there were no Grexits, and we are 21 instead of 16. So the euro was saved and survived, and here we go again. I want to thank you very much for the kind invitation to this important conference. Our discussion on the global environment of central banking could hardly be more timely, to my regret. Today, the escalating conflict in the Middle East is no longer just a geopolitical concern and human tragedy. It is a deeply asymmetric war. It's an acute blow to the global economy, not least to the euro area, which is on the receiving end of the collateral economic damage caused by it. I have therefore revised my title to read How to Navigate Constant Geopolitical Turmoil in Central Banking, a European Perspective. Today, geopolitics affects every dimension of the economy: growth, inflation, financial stability, international cooperation. Both long-term megatrends such as AI and climate change and sudden turns such as the ongoing wars are reshaping our operating environment. And while all eyes look now to the Middle East, we should not lose sight of Ukraine. Ukraine is fighting not only for its own freedom, but for the security of Europe and the future of liberal democracy and civil liberties. Ukraine continues to need our support. And Europe must get serious about reinforcing its common defense as NATO's European pillar. Let me divide the rest of my talk into two parts. I'll first discuss the ramifications of the Middle East conflict and the energy crisis on the making of monetary policy based on the ECB's recently revised strategy. When I discuss these, there will be inevitably some same things as with President Lagarde's and Philippe Lane's presentations. I will try to not repeat what they say, nor contradict, but rather supplement. Some may think we might have some groupthink or danger of groupthink. It's not so. In the Governing Council, we do consensus building by letting the best argument win during the 2 or 3 days of deliberations, say in the spirit of the late philosopher Jürgen Habermas and his theory of communicative action, in the spirit of Herrschaftsfreier Diskurs, which in its pure form is seldom seen in the real world. It's rather a Weberian ideal type. And second, I will focus on Europe's longer-term, largely structural economic challenges. Concerning the impact of the conflict, Christine and Philip already dealt with that, so that I won't repeat. I'll just say that despite the pervasive uncertainty we are now facing, the near-term risk assessment is quite clear. Risks to growth are tilted to the downside. Risks to inflation are, of course, tilted to the upside. Inflation, I won't say anymore, may increase. Inflation will increase this year, while economic activity will weaken. However, the medium-term effects are still uncertain, and that's where uncertainty, unpredictability plays the key role. Let's recall that the ECB's monetary policy strategy of last year and of 2021, which was actually much more important because it changed our price stability definition and inflation target. This strategy particularly underlines our medium-term orientation. Our price stability objective is defined as a symmetric inflation target of 2% over the medium term. And this does matter in the current context for policy making. As a medium-term oriented central bank, we keep a cool head and a broad perspective. What matters most is not the immediate increase in inflation, but whether the shock has persistent effects on inflation and general price level. That in turn depends on the source and duration of the shock and its potential second round effects. The euro area has many decades of experience in dealing with different kinds of shocks. And I want to supplement the previous presentations by providing some historical perspective by looking at 4 periods of inflation in the euro area as follows. In the first period from 1999 to 2009, inflation was well anchored near 2%. The euro area experienced steady growth during what was often called the Great Moderation. This period marked the successful build-up of the euro and the ECB's credibility. The target, more specifically since 2003, then was below but close to 2%. Average inflation in that period was 1.97%, which prompted President Jean-Claude Trichet to ask with a bit of a grin whether we could get any closer to the target than that. A good question. But then the situation changed after the financial crisis. During the Eurozone crisis, for about a decade, inflation was clearly below target, around 1%. At times, there was even a risk of deflation, a fall in the general price level. It was tackled by central banks with strong policy measures, very low or negative policy rates, long-term refinancing operations, large-scale asset purchases, forward guidance. And these measures supported the recovery, brought inflation closer to the target, together with the strengthening of the world economy. Then the third period, in 2021, inflation accelerated sharply as the global economy reopened after the pandemic and production bottlenecks emerged. From February 2022 onwards, Russia's war and the energy crisis pushed inflation even higher, exceeding 10% in October 22. Since the summer of 22, monetary policy was consistently tightened and inflation stabilized around the ECB's 2% target by 2024. Growth weakened, yes, but the euro area avoided the worst-case scenario of stagflation. In the fourth phase, from 2024 onwards, roughly, Europe has experienced stable inflation and modest growth. Now we are again, on the brink, as we know, on the brink of a new period of turbulence. And why this is important? Because it's important to note that during these 4 periods, the drivers of inflation have changed from demand-driven growth to global supply chains and energy geopolitics. And although we have seen energy shocks before, history does not repeat itself. Every shock is different. This time is no exception in that regard. Which brings us to a familiar central banking question. Should we look through an energy price shock or should we react to it even forcefully? Research at the Bank of Finland shows that geopolitical shocks are complex multi-channel events. They do not only raise oil prices, they also increase uncertainty, tighten financial conditions and disrupt international trade, which altogether tends to dampen growth. As a result, the medium-term effects on inflation are not straightforward. Many of us, no doubt, have in mind the 2022 shock following Russia's invasion of Ukraine. That's okay, but it's also worth recalling that not every oil price spike translates into the same inflation outcome. I take two examples. One is between 2011 and 2014, oil prices rose above $100 per barrel due to strong global demand and also due to supply disruptions related to the Arab Spring at the time. Yet euro area inflation and core inflation remained low. Demand was weak at the time because of the euro area debt crisis, which limited the pass-through of energy prices to underlying inflation. Do I need to remind us that the ECB's two subsequent rate hikes in spring 2011 in the middle of the crisis were reversed in November and December that year? Then fast forward to 2022, households and firms still remember the inflation surge of 2022-23, and this may influence expectations. Whether the current oil shock will generate longer-term inflationary pressures will again depend on overall economic and labor market conditions. In 2022, rising energy prices coincided with strong post-pandemic demand. Now, in contrast, geopolitical tensions and tariffs are weighing on growth. In line with ECB's strategy, we analyze these risks using scenario analysis, which help us assess both upside and downside risks in a structured way. Turning to the concluding remarks and second part, structural. When we discuss the transmission channels of geopolitical shocks, we must also recognize a serious structural vulnerability in Europe, which is our continued reliance on imported fossil fuels. This affects both our resilience to shocks and our competitiveness relative to other major economies. Europe has actually improved its resilience in recent years, and the share of fossil fuels in energy production has declined. In this respect, our situation is somewhat better than in 2022. But the energy transition is still ongoing, and energy costs for European producers have remained relatively high since then. All the EU member states, no names, have not used the past years in a responsible way to reduce their dependency on fossil fuels and to enhance their energy security. The impact of the energy shock varies across countries depending on how far the energy transition has progressed. Spain, for instance, has made solid progress thanks to determined policy action. In Finland, likewise, 95% of electricity production is emission-free, 55% renewables, 40% nuclear. This reduces the impact of energy price shocks, but in many other European countries, the buffers are smaller. In our case and in the Nordic electricity market, it's not gas price that is marginal price setting the overall electricity price. It's renewables, usually wind power or wind power together with hydro and nuclear combined. So the Middle East war underlines that the green energy transition is essential for Europe's strategic autonomy and competitiveness and for the climate. Slowing the green transition now would be a serious mistake. Now let me wrap up, dear friends. The great economist Joseph Schumpeter once wrote that the state of the monetary system reflects the state of the nation. Der Zustand des Geldwesens eines Volkes ist ein Symptom aller seiner Zustände. The same is true for Europe. The stability of the euro ultimately reflects the strength of the European economy and the European society. And today we face what I would call a strategic triple test. The first and existential test is security. Russia's war and changes in US policy have made one thing clear: Europe must take greater responsibility for its own defense. And common defense will also require not only national but also European common financing, and that provides a possibility to pave the way for European safe assets that can strengthen our capital markets and support investment. The second test is energy and climate and the green transition. The third test is growth and investment. Both defense and green transition, of course, are requiring massive investment. And this is why completing the savings and investment union is so important, and why we should set a clear and ambitious timetable, for instance, by 1st of January 2008. So Europe's strategy should be invest in defense, invest in clean and digital transition, deepen capital markets, and invest in people. With the right policies and long-term perspective, Europe can turn today's challenges into tomorrow's opportunities. Rest assured, monetary policy will do its part. We will keep inflation expectations anchored and ensure price stability over the medium term. In a turbulent world, we'll act and provide a steady hand. Thank you very much.
Thank you, Governor Rehn. Let me please introduce as our second speaker, Tao Wang. She is Senior Advisor at Union Bank of Switzerland, has moved from academia to the private sector and vice versa, I think, more than once. And in that regard, for example, was also a professor at her alma mater, Renmin University, where she received her undergraduate degree. The PhD is from New York University, very sympathetically on applied econometric issues, and she may be known to many of you as the author of the 2003 book on the Chinese economy, making sense of the Chinese economy. Please make sense for us of the messy world.
Thank you very much for that kind introduction, and thank you for inviting me, for being here. I had indeed spent a lot of time, mainly in the private sector, but also spent some time at the International Monetary Fund. So my expertise is mainly on China, and I think when I initially accepted the invitation, we were considering, of course, a whole different set of issues. If it were a month ago, I think it would be different. But to state the obvious, since this is about monetary policy and spillover effects, let me just think from, I think, the perspective of economic observers in China. There are whether it's policymakers or market observers like myself, I think there are a few trends that we keep in mind to state the obvious. One, of course, is the very heightened geopolitical risk that is increasingly global. It's no longer so localized, and we used to think geopolitical risk exists in a few set areas. And I think nowadays it has become highly unpredictable and with global ramifications. And no one, even from far away of what's happening, can really escape that impact. The second thing is the recent event, the war in the Middle East, for example, is accelerating the supply chain reallocation and also the geoeconomic fragmentation, to borrow the phrase from IMF, that has already been happening in the last few years. Everybody wants to build the buffer for themselves and secure supply chains and so on and so forth. And the third development, I think, behind for all of us is the rapid technology development and application of AI. And I think that perhaps sitting in Hong Kong, in Asia, we see that very acutely. Application of AI is very rapid, and that the implications of that in the long term is very unclear. I'm not an expert. I'm seeing what's happening in Chinese economy. For example, you see huge productivity gains. You also see negative pressure on the labor market very clearly as well. So how is that affecting the overall macroeconomy? Still remains very, very unclear at this moment, and I think it complicates monetary policy decision making. So that's just the general setup. And then in terms of very quickly, what impact recent events potentially could have on China and some countries in Asia. Obviously, higher prices and income erosion and so on. But China and quite a few other Asian economies have built in a little bit of disturbance to that direct transition. For example, in China, any oil price hike from $80 per barrel to $130 are going to be partially transmitted. Anything above $130 will not be transmitted because the government will ask the companies and with fiscal subsidy and so on. But at the same time, I'm concerned about potential some other countries also have fiscal subsidies to oil prices, LPG supplies, subsidies, and so on. But there's also another impact, which is potential disruption of supply. It's not about how high the price may go. It's whether the reserves will run dry quickly. For China, the reserves are estimated to be about 4 months. For Japan, maybe about 9 to 10 months. So that's not an imminent issue. For some other countries, maybe more acute. But on the natural gas front, it's obviously the storage is much more difficult. So I think there could be potentially some supply chain disruptions that we cannot easily see. I'm just remembering what happened during COVID when some disruption of key automobile components in Japan was delayed for a couple of weeks, and that really transmitted into higher auto prices across the globe because there are some one or two key ingredients that there was a supply chain disruption. So I'm concerned that that could appear in gas, in the natural gas somewhere for Asia. So that's, I think, not quite priced in at this moment, and I don't know the answer either. On the trade spillover front, at the moment, in the short term, there may be some positive impact in terms of that overcapacity in the chemicals area in China, for example. Suddenly, we saw last week, for example, their shares all go up because other supplies are disrupted and China can produce. There is increased recognition around the world that maybe electrification and going to renewables and EV and building all the solar capacity was, after all, not such a bad idea. And so there's, in the short term, maybe such positive. But overall, I think the net impact on China will still be negative, because if it has such a big shock to the global economy, and China still export a lot to the rest of the world, and plus this potential supply disruptions, China is the largest importer of oil in the world, so that could still be negative. Let me just quickly go through some remarks that I had prepared before this month's events, which is about structurally what's happening in China. And that is still going on, of course, despite what's hit the news airwave. So what's happening in China is China's economy is undergoing a profound transition amid a very deep property downturn that is yet to bottom. And also, this is happening in the middle of heightened geopolitical risk, multiple rounds of US tariff hikes, and rapid developments of AI and technology, as I mentioned. China's old growth model that had propelled its rapid growth for decades, that has been propelling growth, are facing serious challenges. Local government finances are under deep distress, especially after the property downturn in the last few years. Overcapacity has become more in more sectors, and export as a growth engine obviously seem to still work, but faces constraints going forward. Population aging and decline are dampening consumer and investment confidence and expectations. So all of this is still going on. The government of China has long recognized the need to transition its economic model from even 15 years ago. They need to move away from local government-driven, property-led, debt-financed growth and export growth, and focus on domestic demand and more autonomous-driven growth by market participants and so on. And they have been implementing some policies as well in the meantime, but policy progress, I would say, have been relatively slow. And of course, it was also complicated by COVID, by tariff shock, and by other developments, including the geopolitical risk, the export restrictions by US and other economies that made China double down on self-reliance, on building supply chain of its own, and therefore investing in various sectors more determinedly than before. So the authorities last year the policy rhetoric has changed to that they want to prioritize on consumption, on domestic demand. That said, if we look at the overall policy mix, it seems that there's still a bias towards investment and building new industries, new strategic industries and secure supply chains than supporting overall consumption. And supporting overall consumption is not easy, of course, when the country is in a deep property downturn. And China's household wealth, 60% of them were in property compared to 30% in the US. So, and housing price across the country has come down 30 to 40%. So against that kind of situation, it's going to be very difficult to start with. There are also inadequate or uneven social safety net that is not good for confidence. However, to address that, you need to increase fiscal spending and fiscal, especially fiscal conditions at local government levels are highly in trouble. So there's a lot of constraint on that as well. So the authorities put out piecemeal measures to try to address some of the issues. And I think in retrospect, if we look at the last few years, they probably feel that China has weathered these shocks reasonably well. Despite this sharp property downturn, there is no systematic risk, financial risk, to the banking system, and growth has remained reasonable, I would say. People can dispute on the numbers, but overall there has been no major risk events. And the same could be said on the trade tariff shock as well. And so at the moment, they probably feel that there's no urgent need to bail out the property sector or to embark on large fiscal stimulus to support household consumption. And there's probably, they still desire to continue to invest in new industries. They do now emphasize the so-called supply adjustment, so-called anti-involution, meaning that companies should restrain their own capacity. But that is not easy to reinforce, to enforce, compared to 2015-16 when they did the same with the coal and steel sector. Those were sectors with large state ownership concentration, so they can command the companies to produce less. And now overcapacity are in many consumer and highly competitive sectors with private participants, and you cannot easily enforce those kind of policies. So overall, we think that although the government recognizes the need to transition, but policy tools may be limited, and they feel the risk of changing, very highly uncertain and changing external environment, and so the desire to build some buffer is still, some buffer of supply is still there. On top of that, as I said, AI development, but in China it's not just AI, it's actually also automation and robotics. And so you see manufacturing productivity increasing very fast with that adoption. And also with the economy of scale, Chinese companies are becoming highly competitive. So all of that said, so I just wanted to say that China's incomplete economic transition and its domestic structural balance is behind its large external imbalance. So it's not just a simple question of subsidies to exports, and it's not just about industrial policy, it's not just about the exchange rate. China's real effective exchange rate has depreciated significantly in the last few years, mainly because of domestic deflation, not because of the nominal exchange rate. So the government may allow for some nominal appreciation to maybe ease trade tensions with trading partners. However, I think addressing the fundamental structural issues may take longer. And so that's left us, the rest of the global economy, still with a prolonged period of incomplete transition and therefore imbalance. And if I have a little bit of time, I just want to say for each different group of countries, China's surplus is very different in nature. China predominantly is exporting manufacturing goods, previously mainly in consumer goods, and now increasingly in components and capital goods as well. And it's a large importer of commodities and energy, agriculture, and so on and so forth. So China's export or increasing surplus with, say, some large commodity exporters may not be so contentious. So we are thinking of Brazil and so on, Nigeria and so on, because China still has a deficit with them. And they may not have certain production, so the imports from China is just replacing imports from elsewhere. So that's one group of countries. Another group of countries, mainly in ASEAN, their relations with China is a bit more complicated. They are deeply embedded in the global supply chain. They pursue export-oriented growth strategy, a lot of them, not all of them. And they are facing fierce competition in third markets with China. At the same time, they're a little bit worried about Chinese goods having a shock on their own industry, but at the same time, they may benefit also from China's capacity reallocating from China, both by foreign companies as well as by Chinese companies to them, and they are relying on China's supply of capital, technology, capital goods, and components as well. And an obvious example is Vietnam in this. And then for a few developed countries, most notably Germany, which previously enjoyed surplus with China because their economy were more complementary. They exported advanced machinery, equipment, chemicals to China and imported cheap consumer goods. On that front, I think the picture is changing mainly because I think in many areas, China's own capabilities are rising, so China is importing less from abroad, from Germany, from Japan, Korea, and so on. And increasingly, in some products, they are competitors, both in third country markets as well as locally. So the situation is a little bit complicated. I say all this just to say that it's, to deal with the imbalance, one need to understand, I think, some of the structural factors behind and also different cases. It's not a simple question of whether the exchange rate is undervalued or whether some tariffs or subsidies can address these issues. I think they cannot really effectively. I'll stop here.
Turning to our third speaker, Menzie Chinn. There's renewed talk in Europe how well we would be doing on happiness indices. So in that context, I think there's no question that Menzie is joining us from Madison, Wisconsin, where people feel very happy. He's a professor of public affairs and economics. He's also a co-editor of the Journal of International Money and Finance. And to many of us, he's also known through the Chinn Ito index. That's him. If you have used the index, that's him, an index of the Euro measure of financial openness that's been used a lot in the literature on globalization. And so, of course, that brings us back to the topic of the session. All yours.
Okay, well, thank you. Thanks for the very kind introduction, and thanks for giving me the opportunity to discuss some of my thoughts with you about the world economy and, in particular, America. Let me just say, the way I think about this past year is that, well, every morning when I turn on the news, I am shocked. But in addition, it has been a shocking year. You can think trade policy. Remarkable shock. Policy uncertainty, a topic that had been on the on topics of academic journals and so forth, now sort of has risen to new heights. We have the demise, I would say, for at least the short term, of predictable U.S. foreign and economic policy. We have shocks to oil and natural gas prices once again. And then, yet more new, I think, is the potential for shocks to the credibility of the Fed. So as a non-affiliated academic, I can sort of speak freely about, what in my mind at night when I'm trying to go to sleep, what I think about. Well, that's one of the things that I think about. Each of these shocks, I think we can all say, will hit different economies in different ways. And at the same time, the policy authorities, including the monetary authorities, are going to have policy preferences which we might think are similar, all of those who are imbued with thinking about Taylor rules. They should be similar, but in practice, given the new realities of politics, particularly in the United States, might not be so similar. And so what will happen is likely to be divergent policies, maybe more divergent than in the past. And so let me go through each of these things in step with a little brief recap of what have we seen over the past 13, 14 months. Trade policy, okay? So, it's almost passé. We've been talking about it for years, well, at least a year, ever since Liberation Day, for sure. And what I have here is just a reminder. What has the United States done in terms of effective tariffs? Not just the talk, which, as was pointed out earlier by Professor Bullard, has gone zipping around up and down, possibly day by day. But in practice, what is the sort of the amount of tariff revenue divided by the amount of imports? And what you can see is undeniably what we have is this sharp jump up to about, looks like almost 12% effective tariff rate, which dwarfs anything we saw in Trade War I, that is the 2018, 2019 tariff increases that were associated with the so-called national security tariffs plus the Section 301 tariffs levied against China. Okay, so that was merely a minor blip compared to what we have today, and that increase is still working its way through the American economy. And presumably it's working its way through the world economy as we have reconfiguration of supply chains and other countries are getting hit with demand shocks, essentially. You can see a little bit of the slowdown in world imports, which is a proxy for world trade. There's a slowdown that starts with the implementation of tariffs. That data only goes through November. I'm pretty confident that we'll continue to see a sort of flattening out of world trade flows. So trade policy, massive shock. Don't forget it. It's there and continuing. Uncertainty. And so we've had these uncertainty indexes floating around for past 10, maybe 15 years now. But we've seen really massive increases more recently. And I just want to remind you among what dimensions. This graph has 4 measures. We've got the Economic Policy Uncertainty Index of Baker, Bloom, and Davis, the blue one. That was the original one. That's for the United States. Well, you can look at sort of what they term the world, but really is this sort of major industrial country weighted average, which is the global in EPU. And what do you see? You see in that orange shaded portion, essentially with the second Trump administration, those things have spiked to essentially levels that you haven't seen in a long, long time. They're exceeding, for instance, the pandemic levels, and actually by far. Then the other indices, on the right scale, you have GPR, which is the Geopolitical Risk Index of Caldara et al. And so that is another one of these sort of text scraping indices. What do we have reports of actual threats or actual actions in terms of wars and so forth? That has gone to a new high, at least in the recent times. The only thing that's close is the 2022 invasion by Russia, but it's still early days. We don't know where that number is going to go to. The number you see there at the very end is March through, I think, the 23rd. Okay, well, we still have another week of March, so let's see what happens there. And then you can see trade policy uncertainty is the green line. This is actually a mix, not just of the newspaper reports, but also conference calls by firms. So presumably, in some sense, a better measure of what is the amount of uncertainty associated with international trade. And that too, well, it's not at a spike right now, but we had an earlier spike associated with Liberation Day. So all in all, if you look at this picture, it has been a year that's remarkable in many instances along several dimensions, economic and political and trade. Okay, just a reminder. Now we have oil prices. What you see here is just Brent, very simple picture. Over time, it's true, as was pointed out early, 2022 was a higher jump in oil prices, and it was pretty fast. It predates, in fact, the actual invasion, so the markets were anticipating some event coming up. And then we had a subsequent jump. And it stayed up for quite a while. We are here early in time in terms of the oil prices. We've seen a pretty rapid jump. And then the propagation into gasoline prices and diesel prices has been very rapid, at least in the United States. We can see that that shock is moving along quickly. What is the question now is, as has been pointed out, what's the persistence as well as how high the prices go? If the prices stay at, what seems almost bearable, $100 for Brent, if it stays at that level for a sufficient period of time, that's the big question. What's going to be the impact? But we know that there's an oil shock, at least of some sort. And even if we had a resolution of shipping going through the Straits of Hormuz. Let's say there was some grand accord, point 15 of the 15-point plan. If we were going to have a resumption of oil to go through the Strait, it's not clear at what price and with what reliability and with what certainty. So to me, we're going to have some persistence, at least in terms of this shock for some time. So just to recap, then we have these shocks, but how do we interpret them in terms of the economics? So I was thinking, well, how do I think about each of these shocks if I were talking to my class in the context of some sort of kitchen sink new Keynesian or Keynesian model? And well, we have for trade policy, it's a cost push shock. It might be a supply shock. It might be what you would call a real shock or an IS shock if you were working with the ISLM model. It's a composite. That's the trade shock that we have. And it differs between countries because for the US, the trade shock could be additions to aggregate demand. But for the other countries that have tariffs levied against them, it could be a negative demand shock. We have these uncertainty shocks. How do we interpret them formally in a model? Well, usually, in terms of the academic literature, it's typically modeled as a demand shock. I guess it would be like investment is decreased because you're paralyzed by uncertainty about which way to go. One thing that I have a hard time thinking about in context of a conventional macro model, but I'm sure you could think about it in some sort of game theoretic model, is the end of, at least in the short term, a predictable U.S. Economic and foreign policy. So what you might have taken for granted in the past, we know what the U.S. will do. We might not like it, but you kind of know that the U.S. will pursue its interests to some degree. That, I think, for the short term is sort of off the table. I think, of course, that's why we have all this uncertainty. It's not just risk, it's uncertainty. We just don't know what are the possible states of the world that are coming because we have little basis from the past to make judgments. That's going to make, I think, coordination or even cooperation more difficult going forward. So that's an overlay on top of the other shocks that I'm talking about. We have, as I mentioned now, the oil and natural gas prices jumping up. I would say actually it's a cost push shock for sure. Supply shock, perhaps, depending upon how long the shock persists, because it'll make some amount of capital obsolescent or obsolete, things like that. It's actually, I should also add in there, it might be a terms of trade shock for some countries. For the United States, no, because we're both net importer, we're both importer and, as mentioned earlier, net exporter of oil. But for other countries, other regions, well, they're clearly net importers. That means that they will definitely be exhibit or experience a negative terms of trade shock. And then finally, we have the potential Fed credibility shock. How would I sort of measure that? That is going to mean that, I don't know if it's an expectation shock, but it means that if there's a shock that hits the system, whether it will be built into expectations is going to be possibly different than in the past. So some people have remarked upon the fact that we had remarkably rapid disinflation in the wake of 2022. I think part of the explanation that we would all agree upon is that as long as expectations were reasonably anchored, then that makes sense. Once you take away the supply shock impetus, then you don't need to experience a high sacrifice ratio in order to get beat down with high unemployment inflation. The question that I would pose now is that the case anymore? So each of these things apply with different force to different regions. How I organize my thoughts then is, if I go back to a very basic model, with an aggregate demand, aggregate supply framework, with perfect credibility, it's kind of clear what central banks should be doing. If you face an IS shock or a real shock, price level target. If I face a supply shock, price level target. That's Blanchard's and Galli's divine coincidence of objectives getting you the optimal result. But cost push shock is exactly the thing that is problematic in this framework, and probably any other framework that you can think of. So what should you do? What is the oil shock for key economies? Assuming it's persistent, well, as I mentioned, it depends upon which economy. And for the US, primarily it's a cost push, I think. And not in terms of trade or not necessarily a supply shock. For the US at least, you have this underlying AI investment boom, which presumably goes on for the next year, which is, with its momentum, is propelling the US economy along. But for the Eurozone, for East Asia, it's definitely a supply shock, cost push shock, and it's a terms of trade shock in a big way to varying degrees. And so here you see, I think, one big difference in terms of the impact and hence possible responses between the US and the other regions of the world. Okay, so for sure, I think the US response, especially given whatever pressures are being placed upon monetary policy, is likely to diverge, whereas in the past we might have seen much more commonality of interest in terms of what policies should be pursued. Just to give you a reminder, if you needed one, probably not for this audience, this is the path of the key policy rates in countries. And so it's interesting to see, they followed pretty much the same pattern, with exception of Japan, which is understandable. I don't have People's Bank of China, but we've got, Eurozone, US, and UK. And so, by and large, they followed, not exactly, but they've been responding in a similar fashion. The question is then, going forward, if I can take the policy rates as sort of a summary statistic, do I expect these things to continue to move closely into the future? I think one of the big question marks then in this question is it still the case that I can count on credibility of the Federal Reserve? And so I am sort of ambivalent at the moment, but I always remember the saying, hope for the best, plan for the worst. And so here, what I've noticed is the following observations. I've seen the gap between expectations and the target, sort of medium-term inflation expectations, widen over the past year. Okay, we see increased worries about sovereign debt in the United States, not solely just because of the activities of the current administration, but you know, what's clear is that we have a 5% budget deficit at full employment in the United States with no end in sight, and it's for certain true that the aforementioned big beautiful bill only made that situation worse. So you know, you can understand why there is that worry about sovereign debt in the United States, and you know, some of these things imply a weakening of the dollar. Let me make that a little bit more clear in a second, you know, by first going to the question of whether inflation credibility has deteriorated for the United States. What is this? This is sort of the gap between inflation expectations, in this case measured by the Michigan survey, 5-year inflation expectations, minus the target, where I've adjusted the target to take account for the difference between PCE inflation and CPI inflation. And this Bordeaux-Siklos measure, if you're not familiar with it, is just looking at the difference in absolute value unless you exceed 1% difference, at which point it becomes squared. So you penalize large deviations from the target. What you can see is, even before the war, what happened is that we had this big deviation of from credibility that is associated with, in this particular case, Liberation Day. Okay. Now, as an aside, we all know the consumer surveys are typically way off in the sense that they range, at least in the United States, they range above survey of professional forecasters or market-based indicators. But if you think that credibility is in terms of behavior is being derived or is measured by surveys of households, then this is the correct measure. And what it says is that since the beginning of the Trump administration, on average, credibility has declined relative to what it was before. Okay, and just as a point of reference, if you look at 2022, do you see a spike there? The answer is no. Okay, so I find that a remarkable difference between what happened in 2022 and what's happened since the beginning of 2025. If you are interested in inflation-based, market-based measures, I'll just show you. Blue line is the inflation break-even for 5-year bonds. And so we have a jump with the beginning of the war. So it is still on this basis, daily basis, is higher. We know that inflation break-evens are going to be biased in general. It's unclear which direction. Typically, we think of the inflation break-even as being higher than the true underlying inflation expectations. Here I show in red DKW, which is D'Amico, Kim, and I forget the third author, measure of 5-year expected inflation that's pulled from the yield curve. And so what that indicates is that actually it's likely to be the case that inflation expectations, if you measure it, trying to take away the inflation risk premium, is probably higher than the inflation break-even, just assuming that they're moving slightly in tandem. So my view is that actually inflation expectations have moved up substantially. That's not surprising given the oil shock. But I also think that there's some evidence that the credibility in terms of inflation management of the Fed has been reduced somewhat. Okay, how much? Well, you have to believe in survey data to believe that I've quantified this correctly. Okay. The other thing is more central to my research, which I've been trying to extend to more recent times. We've been trying to examine what's been the impact of measures that the Trump administration has taken with respect to tariffs and other measures in the past, and its impact on whether the dollar remains the reserve currency. Well, it is the reserve currency. There's no doubt about it. But the pace at which that role has been eroded seemingly has been associated in part with, in this case, with the Liberation Day. So if you look at this blue line, and then you see the orange line, blue line is the share of reserves held by central banks that are in dollars. And that's the official data. The orange line is holding constant at 2022 exchange rates the values of the currencies, the exchange rates. So you're kind of counting the quantities as opposed to just the value, right? The value is going to put in, if dollar depreciates and everybody holds the same number of dollars, it's going to look like your shares have fallen. The orange line, in principle, purges that effect. And one thing I'll note is that with the events in the second quarter of 2025, that is Liberation Day, that's one instance where, what happened is that the share of dollars went down by either measure, okay? But even taking into account the fact that the dollar depreciated on net. So to me, that's not proof positive. We'd want a serious econometric regression or regressions to validate the fact that these sorts of policy measures had an impact. I, unfortunately, don't have the data up to 2025 in order to conduct this, or 2026 to examine the impact of the war. But what we can see is that there's been a slow erosion of the dollar's role, possibly enhanced and escalated by the measures that have been implemented by the current administration. Okay, so I take these things together as not proof conclusive, but that the role of the dollar in the international system is not completely secure. It can be eroded. I don't expect it overturning of the central role of the dollar so that it's no longer the primary currency, but you can still argue that the more the dollar is less trustworthy, the higher the interest rate that we'll have to pay in the United States, and also the difference in the shocks that the U.S. has received in the past versus today. So the question then is, taking all these shocks together, how the shocks have hit the U.S. and the Euro area, East Asia, with different force, different composition, different intensity, putting on top of that the fact that the U.S. Central Bank, as of now, still remains under pressure to do what? To have a lower interest rate and maintain growth, perhaps at any cost. The question is, what's the de facto preferences of the central bank, taking into account these pressures? And as these shocks hit the economy, what will be the divergence in policies? Well, when was the last time we can think of inflation expectations being fairly untethered or more untethered, not completely anchored? Well, I go back to the 1970s, so it's ancient history. But this is a time when the U.S. was doing what? The U.S. wanted to push forward and actually wanted Europe or Germany to stimulate their economy at a time when inflation was already rising on both sides of the Atlantic. And on the European side, there was resistance. What was the outcome? The outcome was we maintained a fairly stimulative monetary policy in the United States, and the dollar did what? Here's a graph of what happened to the dollar. The dollar depreciated by about 35% in the course of a year and a half or so. So you start where you cross the zero line is where I've normalized it. It's like September of 1976. And then that sharp spike ends it. Essentially, I think it's October of 1978. So the bottom line is, I can't foresee all the divergences that are going to come up. But to the extent that the preferences de facto of the central banks diverge in response to these particular shocks, and there's a whole series of shocks, we should expect a lot more volatility in asset prices and in expectations about what asset prices will do in the future. So my advice is buckle up. It should be a tumultuous year, yet more interesting going forward.
Thank you once more to all three speakers. Plenty of content for us to discuss, deliberate. As for the first debate, we'll have 4 lead questions. First, in the following order, that Thomas Möllers from Stiftung Geld und Währung would please begin, and then we'll turn to Andreas Billmeier from Bruegel, it's Eisenschmidt from Morgan Stanley, and last but not least, Stefan Kipar from Union Investment. Please.
Yeah, thank you Mr. Binder, for giving me the word. I learned so much about uncertainty. I learned so much about the geopolitical shocks. Nobody knows the future, so how can we calculate? What can we do? I like to take two words you mentioned at the very end. You mentioned, on the one hand, credibility and government deficits. So I think we should also add financial stability as a puzzle piece that we should discuss, especially the government deficits we have in the United States, Japan, France, and the political pressure that nowadays, Donald Trump try to avoid that central banks can increase, for example, interest rates. And I loved the initiative in December that central banks helped Jeff Paul under this impeachment structure when Donald Trump tried to fire Powell, that they said, wait a minute, central banks must be independent and they should not be influenced. So my question is, if central banks have so many economic instruments, why shouldn't we add a legal instrument? A legal instrument that I would call mutual cooperation of central banks or a joint statement of central banks to help central banks in certain affairs. We had it in 2008 in the Lehman crisis, where central banks cooperated and avoided the systemic risk. And nowadays we have states with too high deficits, and why shouldn't we make a statement to reduce deficits, just to reduce the pressure of central banks, not only in the United States, but perhaps also under the ECB, that France, for example, don't like to react, just to make sure that this kind of statement gives central banks an additional measure to coordinate and to react. It would be proportional in relation to the increase of an interest rate if we just make a statement. And in the past, statements had been very powerful. If you take Margot Draghi, whatever it takes, it was a very powerful statement, to create credibility. And so my question is, should we add next to the economic instruments, by buying bonds, also further legal instruments, and here adding the instrument of cooperation between central banks? Thank you.
Thank you very much for the opportunity to ask a question. My question goes mainly to Governor Rehn. We have seen now on several occasions today mentions the AI boom, but also the energy shock. Jim Bullard showed a chart with 2% of GDP investment in 1 year in AI. President Lagarde mentioned the visibility of investment in digitalization. It's in the data, I think she said. And Professor Chinn just talked about it in the sense of the shock after the shock, as in, first energy and then AI second. Now, I tend to, I believe that central banks have been a bit hesitant in sort of putting that AI productivity shock into their forecasts. And the question is my impression correct? Why is that, if it's apparently already in part visible? And then finally, how does the energy shock interact with that? Does it minimize the impact? Does it push it out? So how do you think about the interaction between the energy shock and the AI-driven productivity shock?
Yeah, thank you very much. A quick question that basically goes to all three of you. We have seen a recent announcement by the ECB, also out of the EU institutions, to foster the international role of the euro. I think that one way to see this is as an insurance device against increased spillovers. My question to Olli Rehn would be, is this something that the euro system sees the same way, or is this simply, for instance, this announcement on the bigger or the more activist use of the repo lines? Is this simply following up on a desire from EU institutions to foster the international role? And then maybe to the other panelists, is this something that is that we have any results on, whether this can actually act as an insurance device? I mean, there are trade-offs that come with a bigger international role. So simply speaking, you would have an appreciation at least, so a stronger currency for some time. You get maybe lower interest rates. So how to play that trade-off? And in particular on China, what's the PBOC strategy, given what you have said, is the external rebalancing needs of China? How does the reserve currency status play a role here, and what's the policy you perceive? Thank you.
Yeah, thanks for sharing your valuable insights today with us. I'll try to pose a question for the whole panel, trying to connect your expertise. Well, we heard today a lot about the current environment is different compared to the situation 2022. What's also different is the trade situation, which we heard like minutes before. Europe is in, especially in relation to China. So the Chinese export-driven growth model is flooding Europe with rather cheap goods. That could be worrisome if you're an industry in Europe that also produces that goods and face competition on your home market and also on third markets. But this also probably has some kind of disinflationary effect, dampening good price inflation, maybe allowing the ECB to reach inflation target while services inflation is still a little high. Now my question, first part. Do you think that the deflationary effect of Chinese exports is here to stay in Europe, even in the face of the energy crisis, which might hit Asia even more than Europe? And the second part, how would you assess the impact of the trade situation that it has on the European companies in terms of their profit margins and their wage setting dynamics, and this way, thereby the transmission mechanism of the ECB?
Thank you. So I would suggest we go in the order of speaking, and in your responses, of course, if you'd like to respond to something that a fellow panelist said, please do so as well. Rehn, please.
Thank you very much for the very pertinent questions, and I try to answer to those that are more or less directed to me. First, concerning the question of Thomas Möllers, I find that a very important issue in terms of how we could, in say, somewhat more optimal circumstances, advance international policy coordination. Let's keep it, say, in the reserve once we have better preconditions for this. Having said that, you refer to a legal instrument. Well, all major central banks have essentially, primarily domestic mandates. The Fed, the ECB, Bank of Japan, the People's Bank of China. And I think it would be a fairly long shot to assume that we could have, say, a binding international agreement above and beyond these domestic mandates. But I don't see that a problem. I'm a functionalist, and form follows function. I believe that if you can do it in a pragmatic way, have such kind of policy statements, like as you referred to Mario Draghi's statement or many other statements, we could imagine these do the trick. And in fact, for instance, during the Eurozone debt crisis, which time-wise coincided with the end of the global financial crisis, then I remember in the summit of G20 in Toronto in the summer of 2010, we agreed actually to jointly reduce government deficits, which in that context, to my mind, was in fact helpful. Concerning then the question of Andreas Billmeier as regards whether central banks are hesitant to take into account AI in their policy considerations, I refer to what Philip Lane said earlier on today. He explained very well how we see it at the ECB. In my view, it is clear that the AI will have an impact, but it is quite possible that its impact on macro productivity will behave like the boosts of productivity once we had the second industrial revolution with electricity, or once we had, depends on how you count, the third industrial revolution with the internet. In other words, in the short term, we tend to underestimate the macro impact, even though there is micro impact in many sectors, many businesses, but we tend to underestimate the longer term impact, and I think we are currently in that state. So why we don't take it into account in our policy considerations more than that, I believe mainly because we are an evidence-based institution. You saw after my slides, in the end of my slides, you saw the slogan of the Bank of Finland, which is securing stability in science we trust. So we want to see first traces of productivity growth in the macro statistics before we can take that into account. I know the US debate, Kevin Walsh has referred to productivity increases, but let's see whether this Greenspan era effect will repeat itself, which by the way ended to the dot-com bubble, if you don't remember. How does energy shock play into this? I think AI is very important in this regard because AI is, or say, intelligent solutions to enhance flexibility of demand and supply in the electricity and other energy systems. That is very much key. And for instance, the Nordic electricity market and the countries that belong to it have for the past decade extensively focused on enhancing, say, intelligent energy systems, which are essential if we want to optimize energy use and electricity production. Jens asked about the international role of the euro. In my view, that is an important issue. Of course, it's not an inherent value, but for the reasons of Europe, I would not mind sharing some of the exorbitant privilege that the US dollar has. And secondly, I believe that as US dollar dominance, it's not collapsing, but it is eroding from edges. It is important that we would have several stable international reserve currencies. So it has a value for the world economy as well. And that's why for instance, our liquidity lines, our repo lines, including the recently agreed EU Rep 2.0. Isabel Schnabel is here among the audience, and Isabel is responsible for this in the executive board of the ECB. That is a very important building block of the international role of the euro. So is, of course, digital euro. For the rest, I refer to what I said about Schumpeter. It boils down to the question, what is the strength and dynamism of the European economy? Maybe I'll leave it to this so that we have time for colleagues to respond as well. Thank you.
Thank you. In terms of the greater role of the RMB, indeed, I think there has been long desire from China to have the RMB play a greater role and increase its share in global reserves. So the desire is certainly there, and many people question whether the last couple of years, given the heightened uncertainty related to US that could be an opportunity for China. I think there is opportunity, but there is also serious challenges. So China's trade, actually, if you look at from China's trade patterns, it has been, over the last 20 years, shifting gradually to increased trade with emerging markets and decreased reliance on DM. But of course, everybody still uses the US dollar. So there is a case to be made that trade that China is involved in could be using other currencies to bypass the US dollar. So the trade settlement in RMB has increased a lot. However, of course, to play a bigger role as a reserve currency, you need one thing, which is, among other things, which is a liquid asset to invest in. And of course, China still controls capital outflows, capital account. And you alluded to the fact China has a large surplus, current account surplus, rather than deficit that provides RMB liquidity overseas. I think that surplus versus deficit is probably not the binding constraint at the moment, but the lack of deep, high quality RMB asset abroad is, and also the fact that PBC may be reluctant to let go of controls of offshore exchange rate and RMB interest rate as well. And I think investors are still very cautious over what happened in 2015-16 when the PBC drove up offshore interest rates in order to protect the currency. So I think that there is also, of course, a payment infrastructure that needs to be developed if one is to bypass the US dollar, because the current global payment system is very much in that. I think there are groundwork being laid, but of course the market needs to endorse it as well. One thing on the currency, whether the PBC, what is the policy? I think PBC is among probably the government authorities among the ones that see the need to allow for some appreciation to ease trade tensions and so on. I think recent statement in the last few months from think tanks close to policymakers seems to suggest that that move. However, I do want to say that it's not that the PBC or the government is preventing the RMB from large appreciation at the moment, because until recently the pressure on the RMB has been weakened. So the market wants to, or is betting that the RMB was going to weaken, not strengthen. Despite the large current account surplus, there is actually a lot of capital outflows. So the capital account has turned negative, partly because FDI is negative, and China's ODI, outbound direct investment, is high. And portfolio-wise, I think the desire from Chinese household and corporates to diversify abroad is higher than global investors' interest in holding Chinese assets onshore. So I think that is something to note, and that's something, for example, in other Asian, some of the other Asian countries that has even higher current account surplus as a share of GDP, and see their current account surplus increasing last year, yet see their currency weakening against the dollar, and including Korea, for example. That's because of the capital account, partly because of the tech attraction, tech asset in the US. The question on disinflationary impact of China is here to stay. I think, given my consideration that China's structural transition is going to be gradual, I would say yes over the next few years. In the short term, I suppose that would be a positive, since people are worried about the energy shock on inflation. So that disinflationary impact could be positive in the short term. Very quickly on the policy coordination. 2008, 2009, those were good old days when the US Treasury and Chinese Minister of Finance could talk to each other. I don't know how much of the communication channels still exist nowadays. So I think it may be more challenging nowadays for monetary policy coordination. Even the Fed, I remember the days where the Fed had staff posted to the PBC to exchange and ideas. I don't think that's going to happen nowadays.
Okay, well, thank you for all these interesting questions. I think I'll defer the question about whether we should add, or if we could add a legal instrument to the various central banks to coordinate. The coordination sounds good, but as was mentioned, all the charters for these central banks are primarily domestic, so much so that, sometimes the international branches of central banks feel a little left out of the action. So it would be good. Cooperation usually leads to some better outcome, at least on paper, but I don't see it happening. There are one interesting question that was raised about, why don't we put the estimates of the impact of AI into the forecasts and then plan accordingly. I think of two things. First is, how long did it take for the sort of AI miracle, or not AI miracle, but the computer and information communications technology miracle to show up the data long after we had the IBM PC and so forth. It was a long time. So the timing of when the actual productivity impact shows up is long and variable and probably unknowable at the moment. Then what is the size? It's there. I'm sure it's coming, but when it's coming and how to plan accordingly your monetary policy in order to take into account that is seemingly something that you want to wait until you have some more information, just from my viewpoint. The issue of a greater role for the euro, I'd like to step back and say, is it good that America has so much exorbitant privilege? Well, certainly when I want to get my mortgage, I think it's a good thing to buy a house. It's hard enough as it is. But on the other hand, it's kind of a funny externality wherein we face lower interest rates than otherwise would be delivered in the absence of the externality. So we probably save less and consume more than we otherwise would. And so that goes at the private level, but also probably at the government level, where it's much more easy. So it would be probably a better world where exactly exorbitant privilege was shared more widely, I don't know if equitably, but more widely than concentrated on the United States. So a greater role for the euro if it comes about because euro assets are more desirable than others over time because of good attributes, good governance, integrated markets, and so forth. That's a plus. I think so. In general, better if more currencies could be reserve assets. Now, on the other side, is it a great thing to be a highly sought-after reserve currency? Well, long time ago, as I remember in my graduate school days, does everybody want their currency to be an international currency? Well, you have to give up control. I mean, that's one of the things. You get benefits, maybe lower borrowing costs, but you lose some control, and that's sharply shown in the case of China. If you want your currency to be freely used, heavily sought after, you will have to relent along some dimension. And so that's a matter of the preferences of the fiscal and monetary authorities in a particular country. So pluses and minuses. I do wonder about the disinflationary effects about China persisting. In part, it depends upon the exchange rates. And so that gets back to the issue about if we have the current constellation of preferences in the US versus, let's say, other regions, if there's a consistent desire to let the dollar weaken, what is that? In some ways, it is the old story of trying to reallocate aggregate demand around the world to myself. Beggar my neighbor by virtue of devaluation or depreciation. And so, we could see that sort of conflict occurring as we have these preferences being very different between different regions. That also goes to the issue of what is, in effect, the impact of excess capacity in China, for instance. Does it manifest itself fully, or do exchange rates adjust somehow that it's mitigated? And I honestly have no idea going forward, but that is an open question to me. So, thanks for the questions.
Thank you. I'm looking at the conference organizer whether he allows us one question, maybe from the audience, so that the audience doesn't feel fully deprived. I don't see him, so I ask Isabel Schnabel, please, to ask that one question. One question.
Okay, so sorry for that. So thank you very much for a very interesting panel. I have a question to Tao Wang on precisely the issue that we just discussed, so the final question. How do you think about the path through of the energy price shock to Chinese prices? So I mean, you have different factors ongoing. I mean, you have weak domestic demand, as you said. You have weakening foreign demand. At the same time, you have very aggressive competition in China, so I assume that profit margins are already very compressed. So there is probably not much space to absorb the higher costs in the margins. So what does this then imply? I mean, so do you think that in the end this will lead to some companies leaving the market? Do you think there's going to be government support? What's the role of the exchange rate? Thank you very much.
Thank you for the question. So China, during the previous oil shocks, China has built in a mechanism that it allows only partial pass-through of higher oil prices after $80 per barrel. So the subsidy, to some extent, is provided by oil companies and refining companies, basically PetroChina and Sinopec. So when they import at the international price. When they sell domestically, they are only allowed to pass through part of that to consumers and their clients. So there will be some compression of margins, but most notably is going to be at the oil companies rather than the downstream. Downstream companies, net, of course, will also see the impact as well. It's hard to say at this moment, given that we don't know how long the oil price shock, the war is going to persist and so on. It could lead to, if it's considered to be short-term, there could be some support. But however, if it's persisting longer, indeed, we could see some exit of companies. On the exchange rate side, I think the RMB the policymakers and also market tend to look at dollar CNY rate. So in the current event, actually the dollar appreciates. And so against that, and if the RMB is held relatively stable, effectively it is appreciating as well against other currencies. So I think then they have a less appetite for greater adjustment. In any case, I think China's exchange rate policy has always been managed, and they prefer a gradual move, and they really dislike one-sided market expectations. So I think we should not expect too much use of the exchange rate as the main policy tool to adjust the external imbalance.
Thank you. So we have exhausted our time. We'll carry the remainder of the debate into the break, and then everybody, I'm sure, is looking forward to the third session. Once more, thanks very much to our speakers.